We've got some breaking news now from JPMorgan, and Steve Leisman has the story. Hi, Steve.
Hey, Tyler. Yeah, just got JPMorgan's weekly economic report, and they are calling off their recession forecast for this year. They are crediting the quicker than expected resolution of the debt ceiling, as well as less impact from bank credit tightening as a result of the Fed's program put in place. Now, they are saying recession risk is still elevated for next year. But what's happened is, and we reported on this Monday, I'll come back to that in a second, is they had to boost their GDP forecast for the third quarter. They went up from 0.5 point to 2.5%, along with others. They do say, though, that Fed over-tightening is the major risk to the economy. And I want to show you what we did, what we reported on Monday. Just remind you, we came out with our CNBC Rapid Update showing a host of other folks had boosted that third quarter growth forecast from what was really an anemic forecast to one that's just around trend. It's just the way the quarter has begun, especially now you've had the vehicle sales out. Mark Zandi's at 4%. So there you go, guys. It's hard to have a recession when you have 3 quarters of the economy, that is 3 separate quarters of the economy running around trend. Maybe next year, but as part of JPMorgan, and remember earlier this week, Bank of America also called off their recession call this year.
So I'm curious, they've taken it off the table for this year, but they say the risk is elevated for next year. Is there any color as to why?
Yeah.
Or is it really just the effect of rising interest rates?
I think it's the effect of rising interest rate, but they also signal out the idea of the Fed over-tightening relative to the economy and the inflation problem.
All right, we shall see in the wake of today's jobs report what that might mean.